Welcome back to the Deep Dive. Today we are taking a stack of research, articles, and financial breakdowns that, quite frankly, kept me up last night. We're tackling a subject that promises to completely rewire how you think about wealth, how you look at the businesses you interact with every single day, and honestly, how you structure your own path to financial independence.
It really is one of those topics that acts like the red pill in the Matrix. Once you understand the mechanics of what we're discussing today, you just cannot unsee it. It changes the way you look at a storefront, the apps on your home screen, and definitely how you read a stock ticker. It turns the world from, a collection of products into a blueprint of systems.
I love that, a blueprint of systems. Okay, so I want to start with a visualization exercise. I want you, the listener, to close your eyes for a second. Unless you're driving, please keep them on the road and picture a wealthy empire.
Hmm.
When you think of a company that dominates the world, what specific imagery enters your mind?
And for most people, historically, there's a very specific, almost cinematic image for this. It's deeply ingrained in our culture.
Right, exactly. I picture the 20th century. I picture massive factories with smokestacks pumping out clouds of steam. I see skyscrapers with the founder's name and neon lights on the roof dominating the skyline. I picture bank vaults lined with gold bars, heavy steel doors, security guards. It feels heavy. It feels solid. It feels like if you kicked it, you'd break your foot.
And for the vast majority of economic history, you would have been spot on. The Industrial Revolution, the age of steel, oil, and railroads wealth, was physical. It was heavy. To make money, you had to own stuff. You needed land, you needed raw materials, you needed iron. But in the last 30 years, and accelerating violently during the digital transition, the rules haven't just changed, they've inverted.
Inverted, that's a strong word. It implies the exact opposite. What does that actually look like in practice?
It looks like this. The biggest winners today, the companies generating the most just obscene amounts of free cash flow, they don't own the assets, they control them. We are going to explore the asset-light business model. It is, and I don't think this is an exaggeration, the defining economic shift of our lifetime.
Asset light. Sounds like a diet soda or maybe a low-calorie beer. All taste, none of the calories.
That's actually a perfect analogy. Think of it like a diet for a corporation's balance sheet. It is the strategic discipline of holding on to the high-value components, the intellectual property, the brand, the customer data, the secret sauce, while outsourcing the heavy lifting. The manufacturing, the building ownership, the inventory management.
Yeah.
You let someone else deal with that. It's getting the flavor without the caloric density of owning a factory.
So essentially getting rich without doing the heavy lifting. I think everyone listening just leaned in a little closer to their speakers.
That is the hook. And our mission today is to decode how companies like Apple, Domino's Pizza, and Marriott generate massive, massive cash flow without owning the infrastructure you assume they own. And crucially, we need to bridge this to the individual. How does a listener apply this concept of capital efficiency to a personal portfolio, especially if they are chasing financial independence? Retire early. This isn't just corporate theory. This is a personal finance strategy.
And if you happen to be watching the video version of this on YouTube, you'll see the graphic behind us. On one side, there's a rusty, heavy industrial gear representing that old world, the world of steel and sweat. On the other, a glowing, sleek cloud network node. That is the shift we are exploring. It's the move from atoms to bits, from ownership to access. So let's get our hands dirty, break down the structural difference for us. What is asset heavy versus asset light?
Okay, let's start with the traditional asset-heavy model to set the baseline. This is your classic manufacturer, let's say a car company like Ford or GM in the 1950s. If you are the CEO and you want to double your sales, what is the physical requirement? What do you actually have to do?
Well, if I'm maxed out on production, I can't just wish for more cars. I need to build another factory. I need to buy land, pour concrete, buy stamping machines, install robotics, hire 1,000 workers, set up a cafeteria. I mean, it's a massive undertaking.
Precisely. You are dealing with massive capex, or capital expenditure. You have high fixed costs. Whether you sell one car or 100,000 cars, that factory costs millions of dollars just to keep the lights on, the security guards paid, and the machines oiled. Growth is expensive.
Yeah.
It is friction heavy. Every dollar of revenue requires a significant investment of capital just to exist.
Okay, so every dollar of growth requires, what, maybe a dollar of investment, roughly speaking. It's a grind. It's linear.
Now, contrast that with the asset-light model. In this world, growth leverages other people's capital. Your core assets aren't the machines. They are the intellectual property, the IP, the algorithms, the platform, the brand loyalty.
Give me the mechanism here. How do you grow without spending your own money? That sounds like magic.
It's not magic, it's structural. You turn those fixed costs into variable costs. Instead of building a factory, you outsource production to a third party. You pay a fee per unit. If demand drops, you just order less. You don't have a giant empty building draining your cash reserves. Expansion becomes digital, and frankly, it becomes rapid because you aren't waiting 2 years for a construction crew to build a plant. You can scale from 10 users to 10 million users without laying a single brick.
It's all about agility, but I want to get into the math of this because I know institutional investors, the smart money, the hedge funds, absolutely drool over this term asset light. Why? What is the specific metric that lights up the dashboard?
The magic number here, the holy grail for this type of investor, is ROIC, return on invested capital.
ROIC. I hear it thrown around on earnings calls constantly. We are focused on driving ROIC. But let's actually define it for the listener so we aren't just using alphabet soup. How do we calculate it, and why does it matter more than just profit?
The formula is relatively straightforward, but the implications are profound. You take your NOPAT, that's net operating profit after tax, basically your cash profit from operations, and you divide it by invested capital.
Okay, so profit divided by invested capital. Simple enough. Top number divided by bottom number.
Now think back to high school math. If you want to make the result of a division problem bigger, you have two levers, two ways to win.
You either make the top number, the profit, bigger, or you make the bottom number, the invested capital, smaller.
You've got it. The asset-heavy companies, the manufacturers, the airlines, the energy giants, they spend all their energy trying to make the top number bigger. They try to sell more units, squeeze out efficiencies, just to cover their massive costs. They are pushing a boulder up a hill. But asset-light companies play a different game. They focus on shrinking the denominator.
Right. If you don't have to buy the factory, if you don't have to own the planes, your invested capital is tiny. You're playing with a much smaller denominator.
Which means even if your profit is the exact same as the heavy company, your return on that capital skyrockets because you put so much less money in to get it. The data from our sources is striking here. Asset-light software companies often hit an ROIC of 20% to 30%. Compare that to traditional heavy manufacturers, which really struggle to get 10% to 15%.
That is a massive difference in efficiency. It's the difference between a savings account and a high-performing index fund, but at a corporate scale. It's the difference between running in mud versus running on a track.
And this flows directly into another acronym that is critical for the fire community to understand. ROE, or return on equity. Because these companies aren't spending their cash on building new plants, repairing blast furnaces, or maintaining fleets of trucks, they have this problem, a very good problem, called massive free cash flow.
They have too much cash lying around. That sounds like a problem I'd like to have.
In a way, yes. I mean, they can't reinvest it into machines they don't own. They literally run out of things to buy to make the business grow because the business grows virtually. So what do? They give it back to the shareholders, they pay dividends, or more aggressively, they do stock buybacks.
Which we've seen Apple do aggressively over the last decade. They are buying back billions every quarter.
Aggressively is an understatement. And here is the financial alchemy. When a company buys back its own stock, it reduces its equity base. Remember the formula, return on equity. If you shrink the equity, the denominator, the return percentage goes up. It creates a compounding engine that is mathematically beautiful for shareholders.
So it's almost like an artificial boost, but it's backed by real cash flow. It's not smoke and mirrors. It's simple arithmetic.
It's completely legal financial engineering.
Yeah.
And for a fire investor, someone looking for compound growth to retire early, this engine is what you want powering your portfolio. You want companies that can grow without needing to ask for more money. You want companies that generate cash they don't need, so they give it to you.
Okay, so that's the structural difference. Heavy requires capital. Light leverages other people's capital. But there's another concept in the research that I found genuinely confusing at first. Negative working capital.
Ah, yes. Sometimes called the negative cash conversion cycle. This is where things get really interesting.
Right. I mean, in my personal life, negative usually means bad. If my bank account is negative, I'm in trouble. If my net worth is negative, I'm panic calling a financial advisor. But here you're saying it's a superpower.
It is the ultimate superpower. Let's simplify it. It basically means getting paid by your customer before you have to pay your suppliers.
Wait, say that again. I get the cash from the customer and I hold on to it for a while before I pay the bill for the stuff I just sold.
Yes. Think of it as an interest-free loan from your supply chain. You are using your supplier's money to fund your business operations.
That sounds like a dream. Let's look at a real-world example because the source draws a pretty sharp contrast between Apple and Samsung here.
This is a classic comparison because they are both tech giants, they're both household names, but they run on completely different operating systems, financially speaking. Samsung follows a more traditional vertical integration model. They own the factories, they make the chips, the screens, the batteries.
They control the whole stack, which, has advantages for quality control, sure. If you own the factory, you can tweak the process instantly.
It does have operational benefits, absolutely. But financially, it means their cash conversion cycle is positive. The data shows their inventory turnover takes 90+ days. Their money is tied up in glass, silicon, and warehouse space for 3 months before they see a dime from a sold phone. They have to pay for the raw materials, pay the workers to assemble it, ship it, store it, and wait for it to sell.
Okay, so their cash is just sitting on a shelf gathering dust. It's lazy capital. Now let's look at Apple.
Apple is the king of asset-light strategy in hardware. They don't own the assembly plants. Foxconn does. Apple owns the design, the chip architecture, the software, and the brand.
And the retail experience? I mean, the Apple Store is a temple.
Yes, exactly. So let's look at the data point from 2022. Apple's cash conversion cycle was roughly -62 days.
-62 days.
Think about the physics of that. You walk into an Apple store, you buy an iPhone for, let's say, $1,000, you swipe your credit card, Apple collects that cash instantly. It hits their bank account that night. But because of their massive bargaining power, they don't pay Foxconn or their chip suppliers for 2 months.
So they have my $1,000 in their bank account for 60 days, doing whatever they want with it before they pay the bill to make the phone in the first place.
Correct. They can earn interest on it. They can use it to buy back stock. They can invest in R&D. They can acquire a small AI startup. They are effectively operating their business using their suppliers' money.
That is just wild. Samsung is paying to make the phone, holding the phone, then selling the phone. Apple sells the phone, takes the money, and pays the bill later.
And that float, that 60-day window, when you multiply it by the scale of Apple, creates billions of dollars in liquidity that Samsung simply doesn't have access to in the same way. It really highlights why the financial structure matters just as much as the product quality. You have the best screen in the world, but if your money is stuck in inventory, you are losing the capital efficiency war.
Speaking of how money moves, I want to pivot to a company that I frankly didn't expect to see in a report about high-tech asset-light finance, Domino's Pizza.
The pizza company that thinks it's a tech company.
Hmm.
And is absolutely right.
I mean, come on, it's pizza, dough, cheese, pepperoni. I think of a sweaty teenager delivering a cardboard box in a 1998 Honda Civic. How is this an asset-light marvel? The source calls it a logistics and fintech company.
It sounds like a joke, but when you peel back the layers, pun intended, it is absolutely true. We have to look at their revenue structure to understand the genius here. It's not about the pepperoni. It's about the platform.
Okay, break it down. How does a pizza place operate like a cloud software company?
First off, the franchise model. 99% of Domino's stores worldwide are franchise-owned. Domino's corporate does not own the ovens, they don't pay the rent, they don't pay the delivery drivers, and they don't pay the electricity bill.
So if a store needs a renovation or rent goes up in New York City or the price of gas spikes for the drivers, that's not corporate's problem.
Not at all. Corporate takes a royalty fee on the top-line sales. Whether the store is profitable or struggling, corporate gets its percentage of the gross revenue. Zero risk on the operational costs. They have decoupled their revenue from the operational headaches of running a restaurant.
Okay, that's standard franchising, right? McDonald's does that, Burger King does that. But the research points to something else, a supply chain monopoly. This was the aha moment for me.
This is the hidden engine. You might assume Domino's corporate just makes money on royalties, but actually, about 60% of corporate revenue comes from the supply chain.
60%. That's the majority of the business. So they are a supply chain company that just happens to sell pizza.
Yes. Domino's corporate sells the dough, the cheese, the tomato sauce, the boxes, and even the ovens to their own franchisees. They run massive dough manufacturing centers and a fleet of distribution trucks.
So if I'm a franchisee, I can't just go to Costco and buy cheese because it's cheaper or find a local bakery for my dough.
No, you are contractually obligated to buy from the mothership. It is a captive market. Domino's buys ingredients in massive bulk commodity scale and sells them to franchisees at a markup. They're essentially a massive food distribution logistics company, They control the input, and they tax the output.
That is brilliant. They get you coming and going.
And because of this structure, their operating margins are incredible. The industry average for restaurants is usually razor thin, maybe 6 to 9%. You're always one bad week away from trouble. Domino's corporate operating margins hover around 19.5%.
Wow, that's more than double the industry average. That creates a lot of room for error.
It is. And then you add the digital moat.
Right, the app. I feel like Domino's had a tracker for their pizza before Uber even existed. They gamified waiting for dinner.
They were pioneers. And today, over 85% of their U.S. sales come through digital channels. But there's a fascinating psychological trick here regarding ticket size.
Oh, I know this one. When I call to order a pizza, I feel pressure. There's a human on the other end, maybe it's loud in the background. I just want to order and hang up. I don't want to be annoying.
Exactly. Large pepperoni, thanks, bye.
But on the app has no social anxiety. The app asks, do you want cheesy bread with that? How about a lava cake, extra cheese, a 2-liter Coke?
And I'm sitting on my couch, comfortable, slightly hungry, looking at these high-res photos of melted chocolate, so I thought, yeah, why not?
The data backs this up. Online orders have an 18% higher ticket size than phone orders. People spend more when they aren't rushed by a human interaction. Plus, AI algorithms can suggest exactly what you're likely to buy based on your history. So higher margins, higher average order value, and lower labor costs because no one is answering the phone taking orders.
Correct. And this cash flow machine leads to one of the most bizarre anomalies in their financial statements. If you look at Domino's balance sheet, they often show negative equity.
Negative equity. Usually, if I see a company with negative equity, I assume they're insolvent. That means their liabilities are greater than their assets. That's usually the end of the road.
In 99% of cases, you'd be right to run for the hills. It usually means bankruptcy is imminent. But for Domino's, it's a strategic choice. They are so confident in their predictable cash flow, people will always eat pizza, that they borrow money to buy back their own stock.
They are leveraging up to shrink that share count.
They are. They've returned so much capital to shareholders that the book value of equity went negative. But because the cash flow is real, the stock price keeps climbing. They're a dividend growth beast with over 10% annual dividend growth for years.
That's a bold strategy. It's basically saying we don't need a safety net of equity because the cash flow never stops.
It's high risk if people stop eating pizza, but historically, it's been a money-printing machine. It challenges the very definition of what a healthy balance sheet looks like.
All right, let's move from pizza to hotels, another industry that feels very heavy. You think of hotel, you think of a massive building, hundreds of rooms, laundry services, valets, maintenance crews. Marriott.
Marriott is the perfect example of how an industry can pivot. Before 1993, hotels were largely about real estate. You built the hotel, you owned the land, you ran the hotel, you were a landlord and an operator.
And in 1993, Marriott did something radical.
They split the company. They separated the operations from the ownership. They realized that the stock market values service companies much higher than real estate companies. So they sold the physical buildings to REITs, real estate investment trusts, and private equity firms.
So Marriott doesn't own the Marriott I stay in.
In the vast majority of cases, no. Marriott owns the brand, the reservation system, and the loyalty program Bonvoy. They sign a management contract with the building owner.
And how do they get paid in that scenario?
They get a base fee, which is a percentage of total sales, and they get an incentive fee, which is a cut of the profit if the hotel hits certain targets. They are essentially consultants who run the show.
This sounds like a great deal for Marriott. They get paid off the top.
It's fantastic.
Yeah.
But the real genius of this model shines during high inflation. This is the inflation defense aspect of the asset-light model that makes it so resilient.
Explain that. How does not owning the building help with inflation? Usually, real estate is considered a good hedge against inflation.
It is, but running a hotel is expensive. Think about pricing power. Hotels have daily pricing power. If inflation hits, electricity goes up, wages go up, food costs go up. Marriott can raise the room rate the very next morning.
Right. Unlike an apartment lease where the rent is locked for a year, a hotel room price changes every day, sometimes every hour.
Exactly. So revenue goes up immediately with inflation. Marriott's fees are based on revenue, so their income rises instantly. They catch the wave immediately.
But the costs.
That's the trick. The massive costs, replacing the HVAC system because it broke, fixing the roof, paying skyrocketing property taxes, those are the responsibility of the building owner, not Marriott.
So the building owner takes the hit on the inflating maintenance costs, while Marriott captures the upside of the inflating room rates.
You got it. Marriott captures the upside while shedding the downside. It is a classic asymmetric bet.
It seems like once you understand the split, you realize why these brands grow so fast. They don't have to save up money to build the next hotel. They just need to find someone else willing to build it.
And there is never a shortage of capital looking for real estate exposure. Marriott just brings the flag and the customers, they are the software, the building is just the hardware.
Okay, let's shift gears to technology. We talked about hardware with Apple, but let's talk about software, specifically Adobe, because Adobe went through a transition that I think terrified a lot of investors at the time, but ultimately proved the model.
Oh, the Adobe pivot of 2013. This is legendary in business schools now. This is the shift to SaaS, software as a service.
I remember the old days. You went to Best Buy, or you ordered a box online. It had a CD in it. It was Photoshop CS4 or whatever. It cost like, what, $800. It was huge money, but you owned it forever.
Right. And for Adobe, that meant they got a big chunk of cash from you once every 3 or 4 years, if they were lucky, and you decided to upgrade. It was lumpy revenue. They had to constantly resell you on the new features. Hey, buy this version. It has a slightly better crop tool.
And then in 2013, they said, no more boxes. We are doing Creative Cloud. You pay us $50 a month forever.
This was a massive risk. We call the financial impact of this the cash dip or the J curve.
Why is it a dip?
Because you stop selling the $800 boxes instantly. Instead of getting $800 today, you get $50. In the first month, your revenue from that customer drops by 94%.
Ouch. So your quarterly earnings look terrible. Wall Street must have hated that.
They panicked. The stock wobbled. Customers were angry. They didn't want to rent their software. There were petitions. It takes guts for a CEO to look at that cliff and jump, trusting that the parachute will open.
But they stuck with it.
They cross the valley of death.
Yeah.
And once you get enough subscribers stacking up, the model becomes unbeatable.
Why is it better than the box model?
3 reasons. First, recurring revenue.
Yeah.
It's predictable. You start every month knowing exactly how much cash is coming in. You can plan, you can hire, you can invest. It removes the volatility.
Second,
0 marginal cost. This is unique to digital goods.
no shipping boxes, no burning CDs, no inventory management.
Exactly. To add one more customer costs Adobe literally $0. It's just flipping a switch on a server. Every additional dollar of revenue is almost pure profit. LTV, lifetime value.
Because I'm locked in.
You are.
Yeah.
If you bought the box, maybe you skip 3 versions and don't pay them for 5 years. With the subscription, you pay every single month for 10, 20 years. The total amount of money they get from you is vastly higher.
And the result for the stock?
Since 2012, the stock is up over 1,200%. It proved that the asset-light, subscription-based model is the ultimate wealth engine for software. It became the blueprint for Microsoft, for Autodesk, for everyone. If you look at the YouTube screen, you can see the chart. It's just a straight line up after the pivot.
It's incredible. But as we always do on the deep dive, we have to look at the shadows. It can't be all perfect. If it were this easy, everyone would be a trillionaire. What breaks this model? What keeps these CEOs up at night?
Critical thinking time. Yes, there are significant risks, and the first one strikes at the heart of the franchise model we discussed with Domino's: joint employer status.
This sounds like legalese. What does it really mean for the business?
Remember how we said Domino's isn't responsible for the store employees? Well, prosecutors and labor unions are challenging that. They are saying, hey, wait a minute. You tell them what uniforms to wear, you control their software, you set the prices, you're the boss.
Give me an example of that.
There was a major case in New York. Prosecutors argued that because Domino's corporate required franchisees to use a specific payroll software called PLS, and because corporate was so involved in setting standards for how employees dress and act, well, they were effectively the boss.
They were pulling the strings, so they should be liable for the puppet.
Exactly. If the asset-light parent is declared a joint employer, the liability shield shatters. Suddenly, Domino's corporate could be sued for wage theft, harassment, or labor violations happening in thousands of stores they don't own.
That would destroy the margin structure.
It would add massive legal and compliance costs overnight. It's the biggest existential threat to the franchising model. It turns a technology company back into a restaurant management company.
What about the relationship between the brand and the owners? You mentioned Marriott owners earlier. Are they always happy just paying fees to Marriott?
Definitely not. This is risk number 2, partner conflict. There is a natural tension. Marriott wants to boost top-line revenue because that's how they get paid. The owner wants profit.
And those aren't the same thing.
Not always.
Yeah.
For example, Marriott might demand the owner spend $1 million renovating the lobby to keep the brand standard high. That helps Marriott's image and drives revenue. But for the owner, that's $1 million expense that might not pay off in profit. They might never make that money back.
I see. So the owners feel squeezed. You're spending my money to build your brand.
Exactly. And there have been lawsuits. Marriott owners sued corporate over hidden kickbacks and opaque marketing funds. They claimed Marriott was using their money to build the Marriott brand generally, not necessarily to help their specific hotel. It's a marriage, and like all marriages, fights happen, especially when one partner controls the checkbook.
And there's also the consumer backlash aspect, resort fees.
Oh, everyone hates these. You book a room for $200, and you show up, and there is a mandatory $50 resort fee for towels and Wi-Fi.
It feels like a scam. It feels dishonest.
Governments agree. The D.C. Attorney General and others are suing over this. If regulations clamp down on these hidden fees, it threatens the revenue model, because that fee often goes straight to profit. It's junk fee regulation, and it's coming.
And what about competition? You mentioned that asset light means you don't need much capital to start. Doesn't that mean anyone can do it?
That is risk number 3, low barriers to entry. If you don't need to build a factory, neither does your competitor.
Look at Uber and Lyft.
Perfect example. 2 guys with an app can start a ride-sharing company. Because the barriers are low, competition is fierce. It becomes a race to the bottom on price unless you have a massive brand moat.
So you need to be the Kleenex of your industry, otherwise you're just a commodity.
Exactly. If you are just asset light without the brand power, you will be crushed by new entrants. You need the network effect.
Okay, so we've covered the mechanics, the case studies, and the risks. Now I want to pivot to the listener. We have the learner listening right now, maybe thinking about their own FIRE journey. How do we apply this? We can't all start a global hotel chain.
No, but you can invest in them. And the source suggests a very specific strategy for this.
Let's hear it. How do we build a portfolio that mimics this efficiency?
It's called the barbell approach.
Like at the gym, weights on both ends, nothing in the middle.
Right. On one end, you want growth engines. These are the high ROIC tech companies we talked about. Adobe, Airbnb, Visa. They are asset light, scalable, and still growing fast. They provide the capital appreciation, the rocket fuel for your portfolio. These are the stocks that can double or triple.
Okay. And on the other end of the barbell?
Cash engines. These are the companies that might not be doubling in size every year, but they are spitting out cash and raising dividends. Domino's, McDonald's.
So you balance the high-growth tech with the steady dividend-paying franchises.
Exactly. It gives you capital appreciation and cash flow. It smooths out the ride. When tech crashes, the pizza dividends keep you afloat. When pizza's boring, tech drives your net worth up.
Now, picking individual stocks can be intimidating for a lot of people. Are there shortcuts?
Absolutely. The source highlights a couple of ETFs, exchange-traded funds, that align with this philosophy.
Which one should we look at?
First is MO8. That's the ticker symbol. MOAT. It's the VanEck Morningstar Wide Moat ETF.
I love that ticker. MOAT. It tells you exactly what it does.
It focuses on companies with sustainable competitive advantages. Exactly what we've been discussing. It filters for quality. It buys companies that are hard to kill.
And the second one?
NOBL. NOBL. The ProShares S&P 500 Dividend Aristocrats. These are companies that have increased their dividends for at least 25 consecutive years.
Which usually implies they have a very stable, cash-generating business model.
Yeah.
You can't fake a dividend for 25 years.
And many of them are these asset-light consumer service brands. It's a great way to get exposure to the cash engine side of the barbell without picking winners and losers yourself.
But there is a warning in the source. A hedge.
Yes. And this is crucial. We spent the whole hour praising asset light. But you should not go 100% asset light.
Why not? If it's so good, why not go all in?
Because of hyperinflation or severe economic dislocation. Sometimes having tangible stuff matters.
Yeah.
When the digital world shakes, people want hard assets. If the internet goes down or the dollar collapses, you can't eat software.
Real assets.
The source suggests keeping 10 to 20% of your portfolio in real assets. Things like REITs, specifically ones that own the buildings, like Realty Income or infrastructure funds or energy pipelines.
So if the digital world crashes or the dollar loses value rapidly, owning a pipeline or a rental property is your safety net.
Exactly. It balances the portfolio. You want the digital leverage for growth, but the physical assets for stability. It's about being anti-fragile.
This has been a massive download. We've gone from factories to clouds, from pizza logistics to hotel inflation hedges.
It's a lot to take in. It fundamentally changes how you view the economy.
So let's bring it home. What is the one thing the listener should walk away with today?
It comes down to the difference between ownership and control.
Unpack that one last time for us.
For generations, we were taught that wealth is owning things. My house, my car, my land. But the smartest capital in the world realized that ownership is heavy. Ownership has maintenance costs. Ownership traps you geographically and financially.
So wealth is control.
Wealth is control. It's controlling the system, the brand, the IP. Just as Domino's sells the pizza-making system rather than baking every pizza themselves, you need to look at your own financial life.
Are you digging the ditch, or do you own the patent on the shovel?
That's the metaphor. Economic freedom is about controlling time. You want to build or buy into systems where capital works, not labor. Whether that's buying these stocks or starting a side hustle that uses digital leverage, don't try to carry the world on your shoulders.
That is a powerful shift. I want everyone listening to audit their portfolio and maybe even their career. Are you weighed down by heavy assets and obligations, or are you leveraging efficient systems?
The goal is to be light, to be adaptable.
I'm going to leave you with this thought. We live in a world of infinite digital leverage. You can reach 1 billion people with a tweet. You can sell software to the whole planet with a single server. In this world, the heaviest thing you can carry is the belief that you need to own it all yourself.
Couldn't have said it better.
Thanks for diving deep with us. We'll catch you on the next one.
Stay light.